Hello and welcome to the accounting videos relating to liabilities. We're going to look at a variety of current liabilities and long-term liabilities. So let me start with a quick screen share over here. We're going to start with sales tax payable. In most states, a company will have to collect sales tax when they sell any goods or services to their customers. Sales tax is collected only from the final consumer. So when you go to a retail store, let's say for instance, the bookstore at your university, when you purchase your textbook, if the purchase price is $100, you probably have paid $106 because an extra $6 has been collected from you by way of sales tax. This money does not belong to the company, the bookstore. They have to send that money to the state government. Sales tax is imposed by state governments, not the federal governments, which is why there could be a difference between different states. So here in Maryland, we pay a 6% sales tax on most of our items. So let's take a look at two companies that do collect sales tax, and we will see how they do the accounting. So the first example they've told us is Civic Company enters sales and sales tax separately in its cash registers. That's the right way to do it. On April 10th, the register total sales of $22,000 and sales tax of $1,100. So let's do our journal entries over here. So to start with, on the date of the sale, on April 10th, they're going to record that they collected cash. We'll get to how much cash they collected. How much of it was sales? They've told you the sales is $22,000, so sales credit $22,000. They're also telling you they collected another $1,100. This money is not theirs, so they will correctly credit sales tax payable. This is a current liability because this money has to be sent to the state government typically within 1 to 3 months. It varies by vendors. The larger the vendor, the quicker the money has to be remitted. So the total cash that they collected in the sales is $23,100. Now, at the end of the month, or let's say it's on the 1st of May, the next month, they have to give this money to the state government. So this liability that's in their books will get eliminated. That's going to be by way of debiting sales tax payable. That's $1,100. They have to send the money. It's usually done by an electronic wire transfer, but let's just say they're writing a check. They're going to have cash credit. So sales tax payable debit, cash credit for $1,100. So their sales is only $22,000. That's their revenues, although they collected $23,100. Now here's another company. Watts Company does not segregate sales and sales tax payable. On April 15, their register says they have a total of $13,780. This includes a 6% sales tax. So let's see how they would do their journal entry. This is on April 15. Their journal entry would be cash debit. The total cash they've collected, they're telling you, is $13,780. And what they have done is this entire amount has been credited to sales because all of it was in the cash register. They had not separated it. Now, this is obviously incorrect because I'm inflating my sales and I'm understating my current liability sales tax payable because this money doesn't belong to me, all of it. 6% has to go to the state government. So what they need to do is a correcting entry. The correcting entry is going to be sales debit to decrease the sales, and they will correctly credit sales tax payable. Now the question is, how much of the sales tax, the total amount, is sales tax payable? So the amount this represents, I'll write that down separately over here. We have sales plus taxes, the sales tax, is the total amount. That's the total amount that is collected. We know the total amount is $13,780. This equals whatever the sales amount is plus sales times 6% because we have a sales tax of 6%. Okay, so I will rearrange the terms and I will have my sales tax calculation works out to $780. Okay, once again, how do I come up with this number? I'm going to show you the formula that I've written over here. I'll tell you how that calculation is done. So if I do the 13,780, divide that by 1.06, okay? That's going to give me the sales number. So let me just move this over here. That gives me 13,000. So let's just verify if this calculation is correct, what I did. Okay, so let's calculate 13% of this number. That's 780. When you add the two numbers together, you will get the 13,780. So once again, how did I do this calculation? This number divided by 1.06 will give me the sales number. So the difference then is the amount that was collected as sales tax. So my sales tax is payable is 780. Now again, let's assume that on May 1st, they send the money to the government. The journal entry is going to be sales tax payable debit because they no longer have the liability in their books. And cash credit, how much are they sending over? The amount they're sending over is $780. So once again, remember, on the sales number, a sales tax is collected. This tax needs to be given to the government. It doesn't belong to the company, therefore it's a payable. It's classified as a current liability because typically it's going to be paid in less than 3 months. So this deals with a current liability that all retailers are familiar with.